Hello and welcome to SwitzerTV. I'm Peter Switzer, and tonight I have 4 CEOs and 1 CFO of some of Australia's best companies. I recommend you watch these up and close personal chats between the CEOs of Coles, Coke, Domino and Tyro and the CFO of BHP to work out if you want to be a buyer, a seller or a holder of these companies. Both BHP and Coles have seen their share prices spike since the low point of the coronavirus crash on March 23, and while I suspect they have upside, they do look like great buys off any dips in the market. Domino's has gone sky high and we need a big drop to get in at a good price, but the company looks like it's got its act together, and Tyro looks like a company that will rip when we get over the COVID-19 lockdown in Victoria and closed borders nationally. Finally, my Switzer Report colleague Paul Rickard gives us his take on A2 Milk. Is it a buy or a sell? But first, let's catch up with Birmingham Invest's Julia Lee to look at the companies that reported today and see which ones she really likes following reporting season.
This episode was brought to you by WCM Investment Management, a California-based global equities manager with an outstanding long-term track record. This chart shows the significant outperformance of WCM's quality global growth strategy over the past 1 year, 3 years, 5 years, 10 years, and since its inception. Investors can access the strategy via the ASX with their choice of an exchange-traded managed fund, WCMQ, or a listed investment company, WQG.
Well, joining us as she does each week is Julia Lee from Birmingham Invest. How are you, Julia?
Good. How are you doing, Pete?
Very good. So reporting season so far, Julia, what have been the standout companies that you've liked?
Well, our fund's been doing really well throughout reporting season. We're up almost 10% in the month to date so far. Knock on wood, we've still got about a week to go. But if we have a look at where the growth has come from, it has been from the technology side of things. We have also seen our healthcare companies doing well. So if we have a look at Helios, it should be something that continues to improve in terms of margins, sold its medical centres at a nice price. And it's also doing a lot of the COVID-19 testing, which has helped to cushion the impact of COVID-19 and the areas of imaging, which have slowed down a bit. So I'm liking Helios here, and it has started to run as well, and brokers are pretty positive on it as well. The other one is Charter Hall Wales, one of the few real estate investment trusts which managed to see a revaluation upwards of its properties. It has a yield of around about 7%, which is quite attractive, and it has very stable type of assets, things like Coles distribution centres, Telstra exchange towers, so things that aren't very easily replaced, or the tenants don't get out of those leases very easily. So that's had a pretty stable income through this COVID-19 period, and we continue to like it. I think that it's going to hit above $5 in the coming months, and it's moving quite nicely towards that.
What about a company like Super Retail Group? A couple of weeks ago, everyone had sort of a positive view, but it didn't report all that well today.
Yeah, Super Retail Group is one that we held in the portfolio. We actually sold down our stake today. We like the result, and we also like the outlook for the company. The company came out with a pretty strong outlook, but I guess now I'm starting to have a look at those retailers that have been impacted positively by the COVID-19 period, and asking myself, well, what are things going to look like when the stimulus starts to run off? So I've started to pull back on some of those discretionary names. So I'd be selling in things like, just taking profits in things like Super Retail that has run relatively hard, Shaver Shop. And I guess the difference is things that you buy once versus things that you buy many times. And in terms of things that you buy many times, like the grocery space, I'm still very positive and I still like Metcash. But in terms of the things that you buy once, like hair clippers or things to do at home, I'm less positive in that area and starting to take profits.
Okay. Do you hold anything like Fortescue? Have you been a mining? I know you like Devolution on the gold side, but were you a Fortescue fan?
Yeah, absolutely a Fortescue fan. We don't hold it in our portfolio. We hold Mineral Resources, which hit a record high today. And Mineral Resources, we like it because of that iron ore story as well. Not only has Mineral Resources been increasing production quite rapidly, but it comes at a time when pricing has been extremely strong. And then add in that you have the mining services lever, as well as potentially later on down the track, the lithium lever, which has been a bit of a drag this year, but should start to perform in the years ahead. So we like Mineral Resources, and also in that material space, we hold Oz Minerals, which has been performing well.
Okay, now on the subject of tech companies, you've been a fan of Afterpay. I think it hit $83 today. It's chasing a business in Spain, or it looks like it's got an agreement to do so. I know, I think it was Morgan Stanley had a $100 tag on Afterpay. Are you a believer in the $100 story?
Well, we do hold Afterpay in the portfolio. It's been doing very well. It hit an all-time record high in terms of the market. I do agree that valuations are pretty crazy here, but as long as they're growing into new markets, I guess the key is to have a look at the catalyst, which might drive it down. And really, if we have a look at these high PE ratio growth stocks, they're being driven by what's happening in the US and the NASDAQ. So watching that as a key indicator of sentiment. But a number of the stocks in our portfolio in the technology space reached all-time record highs today. We saw Afterpay, Appen, NextDC all hitting all-time record highs on the market.
Okay, so what's the I guess the latest acquisition that you think has a lot of potential?
So I guess if we have a look at Afterpay, they came out to say that they're making an acquisition in Spain, and that will allow it to really accelerate its product into Europe, which is seen as the next area of growth. And it does make sense that while they have this momentum going, that they try and gain that first mover advantage and try and gain as much market share as possible. And I guess the key question when they're moving into these new markets is, are we seeing a structural shift, a generational shift, which prefers products like Afterpay rather than credit cards? And I think the experience in Australia and the US has demonstrated that. So I think we will see the same type of thing in Europe.
Okay, so let me ask this question one more time, but what have you acquired lately that you think, as a new addition to your fund that has a lot of potential upside?
Sure. Well, it's something pretty boring, but
Good.
one of the great success stories on the market, we bought into CSL below $290 today, and that was just a pricing thing. We thought that it was way too cheap for the pipeline of products that it has in terms of research and development. And look, the main risk here is the collection of plasma, especially in the US. Of course, lockdowns has impacted on the ability of people to be able to donate blood, but that remains a key risk in the current financial year. But I think that flu vaccine sales will be very strong given the Northern Hemisphere's experience with COVID-19. So flu sales should be very strong. Plasma collection is a key risk, but I think pricing will be quite strong because demand for plasma is quite strong. And unlike CSL's pipeline of products, especially CSL 112, which is in phase 3, which has to do with cleaning the plaque off your arteries.
Which is a very important thing for anyone who wants to avoid a heart attack or a stroke. Julia Lee, thanks for joining us on the program.
Thanks, Pete.
This episode was brought to you by WCM Investment Management, a California-based global equities manager with an outstanding long-term track record. This chart shows the significant outperformance of WCM's quality global growth strategy over the past 1 year, 3 years, 5 years, 10 years, and since its inception. Investors can access the strategy via the ASX with their choice of an exchange-traded managed fund, WCMQ, or a listed investment company, WQG.
That was Julia Lee. So now let's have a look at my chat with Tyro's Robbie Cook. I'm an investor in this company, and the analysts at FN Arena think this company has 11.3% upside. I hope they're right. Robbie, thanks for joining us on SwitzerTV.
Thanks, Peter. Thanks for having me on.
All right, mate, I feel sorry for you. You listed brilliantly in December. Everything was going fantastic. Then along came a bushfire season, and then along came the coronavirus. Have you ever used the F word at any time between listing and this interview?
Never, Peter, never. Look, you've got to stay positive, and you've got to deal the hand you're dealt, I suppose. And look, you're right. We went from the highs of actually doing our IPO in December, and it was a time when very few IPOs got up. So it was actually, that was quite exhilarating, and the team did a fantastic job, and we did it in quite a fast period of time. And through to February half-year results, we were looking really strong. We were growing 29%. We were on track, above track for our prospectus numbers, and then, as you say, the bushfires came, and then COVID came. And look, the really sad thing in all of this, we work, as you know, Peter, 99% of our merchants are SMEs, and the impact that both those events had on our merchants was just absolutely gut-wrenching. And so, look, we really pivoted our approach to doing what we could do to actually help the merchants when that all happened. But you've got to say credit to the government with the initiatives put in place, and credit to the resilience of small business in Australia. The way some businesses have reinvented themselves is quite extraordinary.
Yeah. I noticed that in the report today that the trend for New South Wales transaction values are up 13%, but Victoria is down 1.5%. Have you worked out, in a sense, where you might have been if Victoria hadn't been forced into stage 4 or level 4 restrictions?
Yeah, look, it was quite interesting just to track the transaction volumes through that whole period, and we took the steps of putting a weekly update out to market, and the thing that was quite surprising for me was when we hit mid-March, obviously transaction values got really impacted, and April got very, very ugly, and we were sort of down. We'd gone from growing 29% to going negative 38% in the book in April. The thing that was really quite amazing was when we got into June and everything was tracking the right way, we were seeing, we were getting back to 12, 14% growth rates across the book. And then, Melbourne hit the speed bump it did, and it's really, really tough for our merchants down there. But Melbourne's about 23% of our total transaction value. And so it does definitely, with the lockdown, stage 4 lockdown, that puts a big drag on the business. But if that hadn't happened, I think we would have been, we were sort of putting on 2% increases in transaction value on a weekly basis. So we sort of got around the 14, 15% mark. So we would have we probably would have been back to the run rate we were at in February by now if we hadn't had the
So what's your position in the other states, like the lockdown state or the closed border states, Queensland, South Australia, WA, Tassie?
Queensland's been extraordinary to watch. I mean, Queensland's our third biggest market. It's around about 20% of the book. And the performance in Queensland's been very strong. So we're growing well leading into the COVID period, but Queensland really held up well to the extent that we've got, we're around the mid-teens sort of mark in the Queensland market. So the lockdown's been effective here, but it was one of those. It was a tough call, and I've got to say I was on the fence about when in June with the lockdown, because I was thinking a lot of our hospitality and tourism operators in Queensland were suffering by not having the cross-border traffic. And look, I'm a Queenslander, Peter, so I've sort of got a bit of passion for the market here, and I'm up in Queensland at the moment. So I think, in hindsight, it was a strong call by the Queensland government actually to keep the border keep the border shut as long as they did. They reopened it for a couple of weeks and then shut it down again, obviously. So I think that actually worked well for the Queensland market.
How many customers do you have right now, and how many do you think you can grow, despite all the challenges you've got over this financial year?
Yeah, look, we've got about just under 33,000 merchants that work with us, so on the 33,000 mark, pretty much. So, and as I sort of said, we were growing strongly. Merchant numbers before COVID hit, we were growing sort of in the high sort of teens mark. We've been very focused on 3 verticals, so health, hospitality, and retail. And that's really been the sweet spot for Tyro for quite some time. We've got round about, if you look at the SME market in those 3 verticals, which is people transacting between 50,000 in transaction value and 5 million, we've got around about 10% share in that space. We think, we've always thought we can probably double our penetration in just those three verticals. And then for us, it's looking at what other verticals can we specialize in and bring the attributes that Tyro has to new verticals. So we see a really good runway. We don't, COVID's obviously put a bit of a dent in the trajectory, but we will come back through this, and very confident with our approach that we'll go back to the run rate we've seen, and we've got a good future ahead of us.
Will you be helped by the fact that the coronavirus has made people use their cards more and cash is going to become less popular?
I think that's definitely a trend, and we've seen it with debit card transactions. They've increased and ATM transactions have decreased. I think that behaviour is here to stay. I think it'll become entrenched that people will be more inclined to use debit cards, which is good for our business. The other big change we've seen, and we invested in a business called Me and You, which is you might have seen it, it's a order and pay at table solution, which a lot of bars and bigger venues are looking to implement because it gets rid of that counter crush. You can actually sit at your table, you can tap your phone, you can order your beer or your glass of wine, you pay for it in the device, and the wait staff will bring it to your table. So that technology has probably had a 2-year leapfrog in uptake, just because venues are all of a sudden looking for that solution. So we're an investor in that business, but we're also will be the payment provider in that business as well. So when people pay, they pay on the app, and it's our solution which sits in that device. So we can see payments evolving, and we want to make sure we're in that change process. And that for us it's all about being an expert in the payment space and having solutions that are right for the verticals we operate in. And hospitality is a great example with the Me and You product.
What about cross-selling? You've got, as you say, about 33,000 primarily SMEs, I guess, and you're a bank as well, which a lot of people forget. What's your potential for cross-selling then?
Yeah, and look, we've got a full banking license, which a lot of people don't appreciate. So we're a bank. We're a bank, though, in a different way. We're not about trying to fully bank the SME. So we're not a neobank in the sense that a lot of people throw that term around. We see our banking license as being an asset we can use, and it facilitates our payment solution. So that's why we've got the license to start with. But by being a bank, we also can offer deposit accounts, obviously, to our merchant cohort. So that's something where we've got a Tyro bank account, which is a fee-free, interest-bearing account, which is used as a transaction account by a lot of our merchants. Whereas if they had that transaction account with a traditional bank, they'd be charged fees, they'd get no interest. So that's a point of differentiation, and we've got ambitions to make that a very feature-rich banking product. So that's a great thing to have, and so it's different to what's out there on offer. And then we also have a product called Merchant Cash Advance, which you have to be a merchant with Tyro, but it's effectively an unsecured line of credit in a way. So a merchant has a history with us. We've done our analysis about their transaction volumes, and off the back of that, we'll offer an unsecured loan, which can be taken up in the app, in the Tyro app. The merchant decides how much they want to draw down of that loan, and determine how much of their daily settlements they want to pay the loan back, so like 10%, 15% clipped every day. And we quote a fixed price for that loan, and then it just cycles with cash flow. So it's a really innovative product. It's not available from any other banks. And so we can see products like that, which we can provide around our payments solution. It just makes our ecosystem more fulsome. It provides more value to our merchants, and it keeps stickiness and loyalty with the client base.
Okay, so you made the point earlier that you're strong with hospitality, retail in particular, but has this threat of the coronavirus and the fact that your potential growth has been impeded, does it mean that you're starting to look at maybe other industry areas where you might not have looked before as a consequence of, well, the runs are a lot harder in your traditional areas, so where else might there be some easy runs?
Yeah, probably not as a result of COVID, but pre-COVID, we were definitely looking to add 2 new verticals into the mix. So health, hospitality, and retail were a core, And then we were looking to go into the services vertical. So we're thinking particularly in that area of professional services. So I think accountants and lawyers. We're thinking the trades area. So plumbers, electricians, gardeners, landscapers, that space. So that's an area we are thinking about and looking at. The other piece we were quite keen on is the accommodation space. Clearly with what's happened, and we were in the early stages of looking at that space, clearly with what happened with COVID, that's sort of put that ambition on the back foot a little bit, but we will be looking at accommodation in the next, hopefully 6 months, 12 months, when the world gets back to normal as an extra vertical.
Okay, Robbie, is there anything else you think that anyone who is currently an investor or is mulling over the idea whether they should give you a go, is there any better question I should have asked you?
I think they were great questions. I think, I think the thing I'd say about Tyro, where we're different to the major banks, is we're specialists in payments. And I think it's a space that needs that specialisation. And we're trying to do things differently and just stay very focused on great service, fast processing, reliability, and innovation in those verticals. And so if anybody who's got a bit of a fascination about this space or an interest in it, have a read at our annual report, have a look at the prospectus we put out in December. It'll give you a bit of an idea of where things are headed. And
it's nice to know you haven't been swearing as bad luck came your way, but I bet you are praying that normalcy returns to the hospitality and retail sector ASAP.
I'm an optimist, Peter, so I'm sure that will happen.
That was Robbie Cook of Tyro. Now let's go to the CEO of Coles, Steve Kane. The company's share price has spiked, and I don't hold any Coles shares, but the CEO has confidence in his operations' future. I think you might be right. Well, Steve, a nice result. You've had an interesting period with the coronavirus. I guess there are a couple of key questions that shareholders or potential shareholders care about. Is one, how important has the coronavirus effect been to the results of...
Well, what we announced earlier in the year was that sales in Christmas were going very well for us as we implemented our strategy, and that continued through the rest of the summer until COVID struck, and then we saw those panic buying scenes both in supermarkets and liquor. What we also saw is reduced volumes in the petrol forecourts as people stayed off the roads. The other implication for the business was, of course, much bigger cost because we invested heavily in things like health and safety and so on. And what we've announced in the new year is that sales continue to be elevated in supermarkets and the liquor stores, but we've got about an extra $100 million a quarter in additional costs that mainly relate to health and safety for our team members and customers.
So you had the bushfires, you had floods, coronavirus. Did you think to yourself, gee, I got myself an easy job
well,
here?
in some ways I've got one of the easier jobs, and because I work with 120,000 fantastic team members who are trying to do the right thing for Coles customers, and they've just been absolutely outstanding, whether that be in the DCs, whether it be on the front line in stores, or whether it be my colleagues here in the store support centre who've had to transform their lives, like you, into working from home a lot more often.
Yeah, without a doubt. Now, Steve, as we are short of time, I'll cut to probably the most important question for my viewers and listeners, and that is, about a little bit over a year ago, my colleague Paul Rickard, who's a very good analyst, thought that you were good buying around $11. Once you got to 12 or 13, too high. You crept to $14. Obviously, good efforts. And then after coronavirus, you've gone into the $18 mark. And I guess people are wondering, what can you do to keep the performance of the company so elevated that it justifies a share price like that? And I know you're a CEO who won't want to talk about the share price, but your performance is linked to that share price. So we need to know what you're going to do to keep this company of yours flying so high.
Yeah, it's a great question, and I can't speculate on where share prices might go. I'm not a financial advisor, but what I can tell you about is what we're doing in the company, and we're going to continue to develop new products that inspire customers. We're going to continue to take cost out of the business. We took $250 million out last year. We plan to do the same this year, and we want to keep our team members healthy and engaged, and we want to sort of support our local communities, and that's what we've tried to do with organisations like Second Bite and Food Bank as well, where we've donated significant amount of foods to make sure that those in need don't go hungry as well. So all those things, plus a very strong balance sheet, we're in better shape now than we were 18 months ago, with a very solid balance sheet. As opportunities arise going forward, we'll be in a strong position to take advantage of them.
Okay, and what about the migration of so many of your customers now to the online world? Is that going to embed some kind of future profitability and lower costs as a consequence of the coronavirus changing the way we buy and shop?
There's no doubt that COVID has changed the way people behave, both whether it's what they buy, what they cook, what they look at digitally. They're looking at more recipes online. They're doing more online shopping, both in the discretionary and non-discretionary space. We're in an advantaged position, if you like, that we did a deal with Ocado, which is, in our opinion, the best home shopping company in the world. That's coming to Australia in 3 years' time. It's got a wider range, it's got a better efficiency, it's better availability. We're very excited about that coming. And then what we announced last week as well is that we're investing in Coles & Co, which is our new digital channel, which eventually will replace the catalogues that have been delivered to people's doors for decades, and we think it will be a better way of enjoying the Coles value experience and more live video content as well.
Okay, mate. Well, thanks for joining us, and I kept my fingers crossed. A lot of our shareholders do hold Coles shares, and up to you to keep that share price nice and high, mate.
Thank you. Good to see you.
That was Steve Kane of Coles, and my next guest is Don May of Domino's. I think his share price is really elevated, but he's done very well considering all the challenges. The analysts think the company is 20% overpriced. I like the company, but I don't like the share price. I'd be a buyer on any really decent dip. Well, a company that's done well out of this terrible period affected by the coronavirus is Domino's, and to talk about how the company's going, we have the CEO, the group CEO, Don May. Don, great to see you.
Thank you, Peter. Great to see you as well.
All right, so if I run through a quick summary, record profits, revenue $1.9 billion. Is that the best you've done in revenue before?
It is, yeah. It was up 33%. In fairness, some of that is because we had a higher weight of corporate stores where we get the pure revenue. And in Australia, we've changed our distribution system where we now buy all the food just to get rid of another piece of the process that, could be more efficient. Yeah. And so buying all the food means we're booking that as a full revenue as well, rather than just getting a rebate or something like that.
And what's the net profit look like? Is there a record net profit?
It was a record net profit. It's not the most stellar number of all numbers to be talking about, but it was up 3.3%. What was important in that, though, was that we put a lot of support into our system in the early months there of COVID, and so. Yeah, and we're very proud of that, actually, that we stood by our franchisees. No lost franchisees through this whole period of nearly 2,700 stores that we have. And
I presume there must have been a big increase in costs just for the COVID-19 safety measures.
Yeah, so we put out more than 15 million pieces of PPE as a system, much of it donated by ourselves. At the speed we needed to move at, there wasn't a point where we said we're going to have a conversation. We needed Perspex screens up, we were going to pay for them. If we needed masks, we were going to donate them. Very, very early on, if we wanted sanitizer mounted in our foyers, we were just going to bring it into our stores and donate it. So we did those sort of things early on, and first and foremost, keep our people safe and our customers safe. Okay.
Now, Don, even though it's fantastic, and as a country we're cheering your brilliant performance, we really only care about the share price. And I know you don't want to talk about the share price because you can't influence the share price, but the share price often reflects a market view about the company. And so in August 2016 to February 2018, the share market basically said Domino's stank or stunk or stinks. And but now the market says you're a great company, and the share price actually reflects it. What went on over that period, August 2016 to February 2018, that the market didn't like? And then I'm going to ask you, have you fixed that?
Yeah, I think there was a lot of themes that, we think many of them were inaccurate, and time proved that they were. Things like there was a fear that the aggregators were going to actually, There was a theory that Domino's was exclusive in the or in the delivery market, and then aggregators came along. And what most people missed is that this is actually the age of delivery, and aggregators are a piece of the pie. And in fact, it's a tailwind for us. And you can see it year after year, double digit. This year, 21% growth in online. It's a $2.3 billion online business now, one of the biggest in Australia. And so, we needed to show time under that. And we understand that. These themes that come into the market, they're based in theories, which look quite obvious. Another big one was that, we're in 9 countries. It seemed that every year we would have one of the markets would underperform. For example, Japan 3 years ago was underperforming, and shareholders would say to me, gee, Don, why did you buy Japan? It's a low frequency pizza market. Will they even buy pizza? Well, what a stellar business Japan is right now. I mean, it's just been extraordinary, the growth. And same as Germany. Germany, when we first bought Germany, the previous owners had lost multi millions of pounds. And today, Germany and Japan are our 2 biggest businesses. So these are questions that needed time in the market to be sorted through. And I think and there were various other themes, and I think one of the big ones, franchisee profitability. Yeah. And I think franchisee profitability at records right now. So fair criticism to these themes to be worked through the business. I think we got a bit of a speeding fine in 2016 that we've just gone from back to back to back, and then these themes hit us, and I think we've now shown the market that.
Okay. Let me simplify it. So when your share price was killing them, you were actually showing the world how to do delivery and cash in on that market. Then along came companies like Deliveroo and Uber and whatever. So the market, in a sense, thought they're going to eat your lunch, effectively. And don't excuse the pun, because it's a great pun. All right, so what you've effectively shown is that you can actually still compete. So to me, it's a bit like the attitude towards JB Hi-Fi when Amazon came along. The market anticipated Amazon would kill JB Hi-Fi, and they proved the market wrong. So in a sense, what you're saying is it was a legitimate looking threat, but you were able to cope with it and actually grow through it.
Yeah, and I think one of the things people misunderstood is that aggregators are, in our view, just like a giant search engine. So we can grow our business through television or print, the old media. We have our owned media, so our own platforms create business because we're able to, present ourselves out. And then the third area is what we call our frenemies. Now, frenemies are great companies that we love to work with, like your Google platforms, your social media platforms like, Line or Instagram and Facebook. And we call them frenemies because whilst we go and acquire customers in those platforms also get our data, which is quite unique. And an aggregator is very similar. See, what we won't give away at Domino's is that even if we go and acquire an order through an aggregator, Domino's will deliver it. And that's quite unique. You see, in this world of retail, the retailer should own its product, its service, and its image. And we're obsessed with that. Many of our competitors and many of the industry give those things away when they exclusively live in aggregators. And that's not something Domino's is prepared to do, and that's why we've done so well. Okay,
so my analysis of the share price and what was happening in the company showed that even before the coronavirus, you guys were on an uptrend, things were heading in the right direction. But since the coronavirus, with a lot of people locked up at home and, probably not having the best food choices, though I guess you'd argue with that Domino's is the right food choice. The bottom line is there's a lot more pizza eating right around the world, and so part of your uplift in share price has to be this uplift from coronavirus. How do you manage the eventual time, I hope, when people leave the home and go back to the offices and are buying less Domino pizza? How are you going to deal with that?
Yeah, and firstly, we all can't wait for that time either. No one's wishing this on the world. Yeah, I think there's a couple of things there. Actually, the pizza category isn't actually growing right now. It's chain pizza inside that category. So that's an important differentiator. So by and large, food retail is down materially. But people can't just sit at home and cook every single meal. They do want to treat themselves. Domino's is an affordable treat. It's a safe, affordable treat because the only hands that will touch your pizza after it's been baked through our 260 degrees Celsius ovens are your own. So we provided a safe, affordable treat, and that's been really, really important. And what once again, I think this is what's misunderstood. Everything that has accelerated during COVID was already there. Digital delivery was already the biggest boom. People weren't eating more food. They were just leaving restaurants. They were leaving, and the new convenience was digital delivery. What COVID has done is it's brought that forward approximately 3 years. So the macro trend that already exists is just now being accelerated significantly. So when we look at the other side, you can imagine now we're getting all of this customer relationship. For as big as we are, and people think we're a lot bigger than we really are, we're still, by the way, the 5th biggest fast food in Australia. So there's fast food companies that are 4.5 times bigger than we are. And Australians we're not naturally born to eat more fried chicken or hamburgers. That's not in our DNA or our culture that, hey, we're a fried chicken culture. And therefore pizza can get a much bigger place. And globally, it has it's such a big opportunity.
Okay, so it seems to me that the one thing you've been able to do during the coronavirus period is probably introduce pizza to people who weren't generally pizza eaters. I'm thinking about the Japanese people who were locked up in their apartments for a long time because of the coronavirus, and they have tried it. And I guess hopefully your view is that they will at least occasionally buy it when once upon a time they wouldn't. And I guess my key question is if people look at your improved share price and think, let's get in now, or is it too late? What would you say to someone who would say, gee, well, they look like they got their act together, but how are they going to move that share price higher over the next year or so? Because you know yourself, historically, you guys have done brilliantly well, then something goes wrong, go down a bit, and you come back again. People might be thinking, are we going into the phase where the share price comes off the boil? What are you going to do, Don, to change that?
Yeah, I think what's really important is we are living with COVID. So whilst we're very confident in our system, we do have to be realistic that, we sit with advisors, and one of the least likely countries to get another outburst in coronavirus was New Zealand and Australia. And guess what? We now have a lockdown Melbourne and a lockdown Auckland. And some of the most likely places are Europe. Well, there are rising cases in Europe right now. So the first thing I would say to shareholders is get ready for a little bit of a bumpy ride there, because we are living with COVID. And in a lockdown, yes, Domino's will deliver and will be resilient, but that still will put a bit of a headwind on the business. However, we do know pre-COVID lockdowns and post-COVID lockdowns, it is the right environment for Domino's. And, the digital platforms, their delivery performance, we are getting a lot of new customers. And then because we've been doing such a good job with the product and the service and the image that we own, those customers are saying, wow, I didn't realize that was Domino's. I thought that was a fast food company that they had this perception of, well, they really do have premium pizzas. They do have a vegan menu. They are gluten-free. And we're very good at getting people to return again as we earn that customer. So it's a long game. If you're a day trader, get ready for locking up and down of COVID. But if you're prepared to play the long game, which most of our shareholders have through this whole period, then we're going to continue to grow.
Well, I think you certainly do conform to my strategy. You buy quality companies when the market beats them up. One last thing, Don, is tell me about any new food innovation that you might be bringing to the table.
The irony is, in some of the countries we are, like Japan, new products are pretty exciting, but most of your audience being Australian, we're really more focused on execution right now because the volume is there. And one of the new platforms we've just introduced in Melbourne and we're rolling throughout Australia in the next 2 months is what we call car park delivery. So the company that delivers to your home and delivers to your office will now have a concierge service into the car park. Why is that so important? You get pickup prices with no extra charge, but we will put a zero contact process so that we'll deliver that safely into the boot of your car or onto your back seat. You don't, if you've got your kids in the car or you feel the safety, look, I feel safe at home, I feel safe in my car, I don't feel as safe when I get outside in the environment. Well, we'll safely deliver that into your vehicle as a concierge service. So we call that car park delivery. And we think it's going to fill a bit of the gap, especially when we are in lockdowns like in Melbourne right now.
Okay, well, Don, I have to confess I'm not a great orderer of pizza, but I went to my son's place not long ago and he did. And the one thing he complained about was the guy who'd carried the pizza obviously carried it vertically rather than flat. If you go and pick it up, you can lay it flat in your boot and there'll be no cheese sliding along the way.
Yeah, and you know what? Join the 1 in 2 Australians who do buy Domino's pizza. So we now literally 1 in 2 Australians. That's the market share we have. That's such an opportunity ahead, and things like this, yes, do help contribute to improve that upside down pizza or that wrong end.
Don, mate, thanks for joining us.
Thank you. Thanks, Peter.
Up next is the MD of Coca-Cola, Amatil, Alison Watkins, and she shares with us her crystal ball with her company trying to deal with a world challenge by the coronavirus. The analysts think the company has a 5.4% upside. Well, joining me now is the CEO of Coca-Cola, Amatil, Alison Watkins. Alison, thanks for joining us.
That's a pleasure, Peter.
Well, I don't want to dwell on the past too much. I want to dwell more on the future, because the people watching this program can read the past. Net profit was down 35% to $112 million. Looking at the 6 months going forward, which you'll be reporting in February, are things going to get better for you, or will they remain pretty challenging?
Well, I think we're optimistic, and we're optimistic because we've seen some, good signs of recovery in July and August. And really, our business is a function of where people are moving. So if people are out and about and travelling around, then they're out buying a Coke or one of our other beverages. That's good for us. So it really is a function of the measures that are in place, and also how consumers are feeling. That's for sure.
One of the reports that quite shocked me, which quoted you, Alison, and I know you're not a person who likes to shock, so you must have thought this was the case. You made the point that a lot of people will lose their jobs, and that's why you wanted job seeker to be permanently increased. Is that your view on the next 6 months, that a lot of people will lose their jobs?
Look, there's no question. I think we're in for a difficult time. There's a level of government support that is masking or deferring a fairly major adjustment that is inevitably going to happen. These restrictions and the slowdown in the economy are going to definitely play through to a lot of businesses just not being able to get back on their feet again, unfortunately. And we're going to have quite a protracted period, I think, of high unemployment, and we all need to get behind that and play our part in really trying to get the economy moving again. So, I think as soon as we start to see the government support ease back, we'll start to see that more starkly.
I was running through some of the numbers of your products that did well or didn't do well, and I noticed that Coke, no sugar, meant that your overall Coke sales were only down 0.7%. Water was down 20.1%. Coffee was even down 8.9%. Frozen products down 18%, and alcohol was up. Now, I understand why alcohol was up, because people locked up at home have been drinking more. But I was wondering whether the fact that, and I've mentioned this a couple of times on Sky News and also 2GB, that this whole coronavirus has made me think about two economies I've never thought of before, the CBD economy and the suburban economies. And I thought, well, have you been affected by the fact that because people aren't going to work in offices like they used to, they're not buying flavoured milks, they're not buying bottled water, they can drink their water at home? Have you guys seen that and thought that?
Definitely, Peter. It's amazing that the degree of shifts that are going on are quite astounding. So we've seen CBD outlets down, 50% of that order, 40, 50%, and in New South Wales, very slow to get people back into CBD. So CBD is still well down. Suburban locations, regional locations, on the other hand, doing very well. Familiar brands doing really well. So yes, absolutely, brand Coca-Cola's doing really well. Jim Beam's doing really well. Monster Energy's doing really well. No sugar as a theme is doing really well as consumers look for healthier brands. And I think what we have seen growth in spirits, particularly through June, July, August. I would put that down to people entertaining at home more than necessarily indicating any kind of problem, because we really saw it take off once those restrictions on the size of gatherings you could have at home were eased back. So what we've seen is a real trend to people being at home, entertaining at home, exercising at home. And so there's a lot of opportunities for growth if we can really get a lot more nuanced about the at-home occasion and be there and support people with that.
Well, I went through those numbers. I thought to myself, you probably said to yourself, gee, I wish I'd gone longer alcohol.
We're very happy with our alcohol portfolio. Thanks very much, Peter. But we're glad to see it doing well for sure.
Okay. I couldn't help teasing you on that one, Alison. Let's move to outside Australia. What's happening to your business outside Australia because of the coronavirus?
Well, it's really, we've got on one extreme New Zealand, which has been doing exceptionally well, very severe lockdown back in April, early May, and then a fast bounce back late May, June, and onwards. You know, they've really been doing very well. They've got some restrictions back in place now as they manage a current outbreak, but I think overall that business is in really good shape. Indonesia, we're seeing the pandemic still playing through, so daily infections haven't yet peaked in Indonesia. So it's still, from a health point of view, a place where consumers understandably are being very cautious and staying at home a lot, not tending to go to their workplaces or being out and about or public transport the way they normally would. So that's having a big impact on the market in Indonesia, and it'll have a big impact on the economy for some time, unfortunately. So we're really focusing on affordable offerings and making sure that we've got the right at-home offerings. That's absolutely where the growth will be in Indonesia.
Okay, let's come back home again, and your beloved state, Victoria, in lockdown. It clearly would be a significant contributor to your bottom line. How much do you think your overall profit will be affected by the fact that Victoria has to go back into lockdown?
It's a setback, there's no doubt about that. And we really feel for all of the customers and all of the Victorians who are impacted by this. I think what worries me is whether some of those cafes who got through the first time round will have the financial strength and the mental strength to be able to bounce back after this setback. The good news is, though, we're going into summer, and so I think that's a good time. And I think it's also a time when everyone's going to want to support all of those wonderful bars and restaurants and cafes that are so much the heart of Melbourne to get back. So I'm really hopeful. The numbers are coming down quickly. So as soon as we can ease those restrictions and people can get moving again, and as we head into summer, I think we will manage the impact. For us, Christmas, December is a massive month. So if we're all set to go and in good shape, then that can make up for a lot. Okay, one last one, because this is a national issue that has implications for your business and lots of business around the country. Are you hoping that the states that have closed borders will consider the relative success that New South Wales is having in basically seeking and destroying and containing the coronavirus, and as a consequence we see open borders ASAP? I really hope that's right. I think it's very important. I mean, I think this targeted approach, and we're seeing the Queensland government applying that right now, that's where we've got to get to, is fast identification, tracing and isolating people who've either got the virus or have been exposed to it. If we can do that with very fast cycle times, then we can be very targeted in the areas that we lock down, and that's absolutely critical. And really, state boundaries should be neither here nor there as we developed a more nuanced approach to this kind of rolling lockdown cycle that I think we're going to have to learn to live with. Well, one last question, Alison, and it's not going to be an easy one, but all my viewers want to know, do you reckon the dividend will increase next time you speak to us? I wish I had a crystal ball. I think our shareholders know that we understand they value the dividend. That's a high payout ratio has been a feature of Coca-Cola Amatil, and we're pretty keen to get back there as soon as we can. Alison Watkins, thanks for joining us. Thanks very much, Peter. And next we have the CFO of BHP, Peter Bevan. After watching this interview, you'll see why this company has done so well. The analysts think the company has a 3% upside. So I'm talking to the CFO of BHP just after their report, and I guess you'd have to say, considering the kind of environment they've been working in, quite an extraordinary performance. Welcome, Peter.
Thanks, Peter. Great to be back.
Okay, so everything seems to be a little bit down except debt, attributable profit, basic earnings per share, the dividend, net operating cash flow, but basic underlying EPS is up. Why don't you give us a CFO type explanation of what's going on here?
Well, I think what's going on here is that, I think the organization, as you say, in the midst of some absolutely unprecedented changes and so on, really stood up. I think the things that we controlled went really well. We reduced our unit cost by 9% across the board in the year, and that is on top of a whole bunch of reductions we've made in previous years. And we produced, again, very strong production results across the board. So those things, you put those things together, we produced $22 billion of EBITDA, and we continue to invest in the company. Put $7.6 billion to work, because we need to look after the future, and we still made $8 billion of free cash flow. So great news out of all of that is that, strong balance sheet right at the bottom of our net debt range, continue to invest in the company, still stacks left over for shareholders. So we declared, again, a nice, good, strong dividend today. It's the third year in a row that we have declared more than $6 billion US cash returns to shareholders out of ordinary dividends. So, really great. I'm super happy with that.
So the dividend's down a little bit. Is that because you're storing up for the uncertain future?
Yeah, I think we were down. The dividend was 65 at the interim, 55 this go. Still, it's almost $3 billion worth of dividends, so it's pretty good. I'd say, look, it is an uncertain world, and COVID is not done by any stretch of the imagination. Surely, it feels like the world has come out of the worst of it. But as we know, you and I live in Victoria, and we know what the impacts of second, third waves and so on, we've got to be a bit, we just got to be cognizant about that. Look, the way our dividend works, every 6 months we start afresh, we make a new decision. And in 6 months' time, we'll know some more. And as I say, I think our track record has been reasonable about getting returns to shareholders. Company's in good shape, and I think we look forward to another strong 6 months.
Okay, so you made the point that your unit costs are down. Talks about the sales that have gone on compared year on year.
Yeah. So I think we continue to sell everything we produce, and notwithstanding the fact that the rest of the world really struggled when COVID hit home and so on. In particular, the very important markets that we traditionally sell into, which are Japan, Korea, Taiwan, obviously Europe, obviously the US, and so on. And so, but China went in first, but it came out in a rush. So it came in it was a very steep V. And so, really, I think this has been the story of the last few months has been weakness in the rest of the world, but real strength in China as they come back out of this thing. And because of the nature of our asset set, which is diversified, very low cost, some of the heavy lifting was done in the last few months by iron ore. And less so with oil prices being down, coal prices and copper and so on. But that's, again, the nature of this thing. It all balances back out to an excellent return, and numbers for shareholders.
Okay. Well, I know this is a hard question, but you're the kind of guy who has to answer this kind of question. The outlook for the price of iron ore been great this year, better than what I think most of us expected.
Totally.
For 2021, are you kind of thinking that China will keep on buying and there'll eventually be a global recovery, therefore the iron ore price remains at good levels?
Yeah, I think, Peter, there's two things that have really strengthened the iron ore price over the last few months and so on. The one is obviously China and its huge bounce out of the COVID thing. We think that'll continue to be the case. We will hopefully be able to see a little bit more iron ore demand across the world, because it's not just a China story, from the rest of the world as it comes back to life post-COVID and so on. Probably a little less, probably more impact on coal from that than it is on iron ore. But the other thing that has been driving iron ore has been weakness in the supplier base. Initially, some part of our competitors in Western Australia, our business ran really, really well. But I suppose the real story on the supply side has been the weakness out of Brazil. And that was weakness because of the dam failure in Brumadinho that Vale had. Plus, COVID has been a big issue, very big, continues to be a very big issue in Brazil. So you put those things together, meant there was less tons in the market from a very strong competitor, and at the same time, demand was getting off. Now, as I said, demand will probably continue to be strong, but those tons will start to come back into the market from Brazil. And in addition, there's lots of iron ore tons that just pop out of the woodwork from everywhere else because of the strength of the price. So, probably it's going to moderate from here, I'd say.
Okay. On the subject of the China economic recovery, obviously it's not easy for a company to work out what a country's going to do.
Yeah.
But are you expecting the growth to pick up? Because the numbers are still low for China in terms of historical growth numbers. Are you expecting them to ramp up over 2021?
I think, again, Peter, you think about that economy in two parts, I suppose. So you have the investment part and you have the consumption part. Really what has been driving the economy in the recent months has been the investment part. And so you've seen very strong numbers out of construction, some good strong numbers out of manufacturing and machinery and infrastructure, which is another big part of it, as the government puts its dollars to work to stimulate the economy and, of course, invest for the future and so on. The piece that is lagged a little bit in China is the consumption side. Still uncertainty in the minds of the consumer and so on. And so there has to be a little bit of catch up, I think, still from that to continue to rebalance that economy. Look, put that aside. As I say, we continue to be, as we've been for many years, big believers in the ability of the Chinese economy to continue to grow and do. And I think the other thing I'd say also is, you recall in the GFC, they had the similar sort of thing. China came out of that and they just threw everything at it, right? And they had, and they ended up with a whole bunch of investment, which was in their minds, it was quite wasteful in certain respects. And this time, I think they've learned the lessons out of that. They've been very explicit about that. And so we think that the money that they have used to stimulate their economy is better placed and is more sustainable, I think.
Your CEO has talked about the company exiting thermal coal. I guess in many ways it's a bit of an advertisement for anyone out there who wants to buy it off.
Absolutely it is.
Yeah, but you're the CFO. Like, how much do you lose, and can you make up that loss in terms of the bottom line?
Honestly, Peter, this is a tiny part of our portfolio. This is 3% of our net asset base. So it really is a rounding error in our business. It is exactly as you say. There is a strategic element to this. This is a commodity we're not really going to put money into, and so given it's such a small thing, let's give it to somebody else to have a crack. Probably better value for shareholders. And you're right. We don't have all the I's dotted and the T's crossed on this one. So probably it is something. We've given ourselves a couple of years to execute, and it's a good investment for anybody else who's got a good idea. Why not?
Okay. Well, I know you studied economics because you're a CFO, and I taught economics, but I never taught pandemics 101. when the pandemic hit your company, and you had to come up with the game plan,
sure.
which seemingly has worked in terms of the numbers.
Sure.
How hard was it to make sure you could get all these people, men and women, digging stuff out of the ground, getting in on the trucks or trains, in the boats, and into your customers' warehouses or silos or whatever it might be? How hard was that?
Yeah, I think Peter, there's two elements of it. One was easier, which is how did we think about the balance sheet and as a company in good financial shape and all the rest of it, because we think about downturns from whatever source as a day-to-day thing. We're a resources company. We're used to cycles and we're used to shocks. From whether it's a GFC or it's a pandemic, it doesn't sort of matter. The impact is the same. So that piece was, believe it or not, relatively calm. We had a balance sheet. We knew what was going to happen, and we planned for it, and it coped. The other part was something completely different. Now, how do you get a whole bunch of people to, in the midst of this huge uncertainty in their own lives, because their families are part of this themselves, and you ask people to stand up and say, okay, now this is where we're at, we've got to be this, and I hear the concerns. Well, we're going to keep you safe at work, and we're going to ask a bunch of you, because a bunch of people live interstate, for instance, and we're going to ask you to change your rosters. In fact, we're going to ask you to change where you live for a period of time, so that so we can continue to make the organization continue to function. Our people absolutely responded. We had 1,000 people over the course of a weekend. Recall when they shut the borders and so on. interstate. That sort of came, I wouldn't say out of the blue, but nobody had a lot of notice. And we asked people to relocate. 1,000 people relocated in the course of a weekend interstate to continue to go to work. You say, well, how does that happen? Well, of course, it's the caliber of the people that we have. But really what it was is that the sense of, okay, this whole country is in this issue, and there are some essential parts of this country that need to work, such as the health system and so on, obvious things like that, but also the resources sector. We are such a big contributor to the economy of this country, to the taxes of this country, to the communities that we work with, and so on. And people said, well, it's like a duty to go and do this. And we had everybody more or less across the world, not just in Australia, have that attitude and come and deliver. And, I'm very proud to work for this company, and I have been for many years, but, at that point, you really know it's something special. It's a big deal. Yeah. So anyway, good for that. Yeah.
Peter, thanks for joining us. I hope you get freed from your lockup situation ASAP.
So do I. Absolutely. Thanks very much for the time. Thanks, Peter.
Finally, Paul Rickard looks at the market darling A2 milk, which the analysts believe is about 6% too pricey. Paul?
Look, I really like the A2 milk report, Peter. I mean, look, it probably disappointed some of the analysts because it sort of hit expectations, not much more. But when you see the numbers here, earnings, profitability and revenue up about 33 and 34%, that's my type of company. Have a look at this chart, and that shows you the history over the last 4 years. You can see revenue up, earnings up, and of course the return to shareholders, effectively EPS up. I really like those sort of companies. Market perhaps a little more concerned about some of the so-called Chinese risk, again, as because A2 does have a fair chunk of its sales coming out of China, but I'm a little bit less concerned. It is a New Zealand company. That might actually work for it, and if there's any sort of continuation of the dispute that we've seen affecting things like the wine industry. Also a bit of a concern perhaps around whether their EBITDA margin next year, a little bit lower than perhaps this year, suggesting higher costs. But look, I think this is a company doing the right things. I think you back track record, and if you get a bit more of a sell-off in this company's shares, this is one to buy. One to put in the watch portfolio, in a sell-off, a good company to back for the long term.
That's the show for this week. And if you want to read about my take on Tyro, BHP, Coles and Domino's, take a 21-day free trial to the Switzer Report. Just go to switzerreport.com.au. I'm Peter Switzer. Thanks for joining me. I'll see you next week.